When a stock rockets up over 13% in a single day, are you looking at a golden opportunity or are you staring right into a value trap?
That is the million-dollar question.
It really is. Welcome to the deep dive. It is May 2026, and today we are unpacking Waters Corporation, ticker symbol WAT.
Yeah, and we have a lot of ground to cover with this one.
Oh, absolutely. We're going to cover everything from the underlying financials and stock price history to the latest technical analysis, the analyst ratings, and, the ultimate debate on whether this is a genuinely undervalued gem or just a trap waiting to spring on unsuspecting retail traders.
Which happens a lot.
Way too often.
Yeah.
But before we look under the hood to see if the engine actually justifies this sudden speed, do us a quick favor. Hit that like button, subscribe to our YouTube channel, and absolutely leave your feedback and your own thesis in the comments below.
Yeah, we definitely want to know where you stand on this.
Exactly. So getting right into it, that 13% single-session surge is really the perfect starting point for us today.
Oh, for sure. Because a violent upward movement of that magnitude, it completely scrambles standard risk models.
Right.
It forces anyone watching the market to ask, what did the broader financial world suddenly realize on a random Tuesday that it completely missed on Monday?
Okay, let's unpack this.
Yeah.
Because to figure out if that massive gap up is just a fluke or a real foundation, we really have to look at the raw financials first.
The engine room.
Exactly. Yeah. So for fiscal 2025 and moving into the first quarter of 2026, Waters Corporation is reporting total revenue of $3.165 billion.
Which is substantial.
It is. That is up 7% year over year.
Yeah.
And in the biosciences and diagnostics space, where revenue streams can get incredibly lumpy.
Oh, very lumpy, depending on clinical trial cycles and lab budgets and all that.
Right, exactly. So a steady 7% growth in that environment is a massive green flag.
It really speaks to the stickiness of their products. I mean, once a laboratory or a pharmaceutical company integrates your testing equipment into their daily workflow, they rarely swap it out.
Because the switching costs are just too high.
Exactly. The training, the recalibration, it's a nightmare to switch. And that stickiness translates beautifully down the income statement.
Yeah, let's talk about that.
We are looking at a net income of $642.6 million and an EBITDA, so earnings before interest, taxes, depreciation, and amortization, of a staggering $1.09 billion.
Wow. I always love looking at EBITDA because it strips away all the creative accounting and the tax maneuvers to show you the raw cash-generating power of the core business.
It tells you if the actual machine is working. And in this case, the machine is running exceptionally hot.
Yep, it is.
We see the same story in their earnings per share, too. The diluted GAAP EPS sits at $10.76.
Oh.
However, when you look at the non-GAAP EPS, which, removes one-time accounting noise like restructuring costs or acquisition fees.
Just to give you that true picture of day-to-day operations.
Right, exactly. It jumps to a very impressive $13.13.
Okay, so the income statement is basically pristine, but earning money is only half the battle, right?
Yeah.
Managing it is the other. Let's look at the balance sheet.
Always a good idea.
They have total cash sitting at roughly $587.8 million. But against that, they're carrying total debt of $1.54 billion.
Right, the debt load.
Yeah, which puts their debt-to-equity ratio at about 60.3%. Now, for some listeners, hearing that a company has $1.5 billion in debt and only $500 million in cash sounds like a massive red flag.
It can sound scary.
It does, but, think of it like a household. Imagine a family that takes out a sizable mortgage to buy a great house. That is the debt.
Sure.
But they also have an incredibly reliable, highly paid salary. That salary is their cash flow. As long as the salary keeps hitting the bank account every 2 weeks, the mortgage isn't a crisis. It is just a managed expense.
I love that analogy because what's fascinating here is how clearly the cash flow metrics support that exact household scenario.
Oh, really? Break that down.
Well, Waters has an operating cash flow over the trailing 12 months of over $652 million.
Okay.
And their free cash flow, so the money left over after they've maintained their business and paid for capital expenditures, is over $427 million.
That's a lot of free cash.
It is.
Yeah.
Plus, we have to look at their current ratio, which sits at 1.73.
Meaning for every single dollar of short-term liabilities, bills they have to pay within the next 12 months, they have a $1.73 in highly liquid assets ready to cover it.
Precisely. They have a buffer. It is debt, yes, but it's highly manageable short-term liquidity. The company is generating more than enough free cash flow to service that debt comfortably while still, reinvesting in new technologies.
Right. So that brings us to the stock price and the history. Over the last 52 weeks, Waters has seen a low of $275.05 and a high of $414.15.
A pretty wide range.
Yeah. And as of our latest data in May, the price is sitting at $342.75. But here's a detail that really stands out when you dig into the activity.
The insider trading.
Exactly. It's incredibly quiet. Management has only bought about 1,500 shares over the last 3 months.
A detail like that is crucial because it tells us the anatomy of this breakout.
How so?
Well, if insiders were buying hundreds of thousands of shares right before a 13% pop, you'd assume they were front-running good news.
Right, like they knew something we didn't.
Exactly. But this modest insider activity proves that the massive surge wasn't manufactured by insiders. It was an organic, aggressive reaction from the broader market finally waking up to the fundamental strength we just outlined.
But those fundamentals have been a fortress for a while. I mean, a fortress doesn't just suddenly jump up and moves a mile down the road on its own.
No, it doesn't.
That requires a catalyst. And technical analysis is what explains why a fundamentally strong stock violently gaps up instead of just, slowly drifting higher. Let's talk about the trend.
Yeah, the charts are fascinating here. Before this earnings report hit the wire, the stock was locked in a very neutral, consolidating trend.
Just drifting.
Basically. It was moving sideways, building a base, just waiting for a reason to pick a direction. The earnings beat was the spark that triggered an abrupt, violent shift into a sharp, short-term uptrend.
Okay, but momentum shifts like this scare me a little.
Oh, they definitely can.
Because when a stock goes nearly vertical in a single session, my first thought is, wait, are we just looking at a short squeeze?
The classic squeeze.
Yeah. Like, is this just a bunch of short sellers panicking, buying back their borrowed shares to cover their losses, and artificially inflating the price? Because looking at the 14-day relative strength index, the RSI, it's sitting at about 56.16 and moving rapidly toward overbought territory.
Right.
So how do we know this isn't just a technical fake-out?
It's a great point. This raises an important question, and it is exactly what you should be asking whenever a large-cap stock experiences a double-digit daily gain.
Right. You want to know if it's real.
You want to know if the foundation is made of concrete or quicksand? But the data here suggests this is concrete.
Okay. Why?
Look at the MED, the moving average convergence divergence.
Right. The momentum indicator.
Yeah, think of the MACD like a speedometer for the stock's momentum. It doesn't just tell us the price is moving up. It measures the distance between short-term and long-term moving averages to tell us if the stock is actively accelerating.
And what's it doing right now?
Right now, what's fascinating here is it's showing a strong bullish crossover, meaning the pedal is hitting the metal. It's rooted in fundamental strength, not just a squeeze.
And it blasted right through some major historical resistance levels to do it.
It did. It broke definitively above the 50-day moving average at $309.30.
Huh.
And even more importantly, it shattered the 200-day moving average at $335.18.
That's the big one.
It is. When a stock breaks above its 200-day moving average on massive volume, it's flashing what traders call a golden signal.
Because it forces the algorithms to react.
Exactly. You are literally forcing institutional algorithms to flip their psychological bias from bearish or neutral to undeniably bullish.
So it wasn't just a long squeeze or a short squeeze, it was a fundamental repricing.
Exactly the opposite of a meme stock rally. The true catalyst wasn't just a good first quarter, it was a forward-looking Q2 guidance raise.
Oh, right. The EPS guidance.
Yeah, management announced they are now expecting EPS between $2.95 and $3.05 for the upcoming quarter.
Which changes all the math.
Completely. When a company raises guidance unexpectedly, institutional investors, the mutual funds, pension funds, ETFs, they have to completely recalculate their valuation models.
Oh, wow. So they have to buy in.
What you saw on the chart was a wave of institutional reweighting. Those massive funds literally had to buy millions of shares to ensure their portfolios matched the new, higher fundamental value of the company.
Which establishes entirely new floors for the stock. I mean, the previous close before the gap up was $301.88.
Right.
That is now a massive level of support. And below that, you have support at $292.13. On the upside, it's facing resistance at the recent daily high of $347.99.
Exactly. The technical bounds are completely reset.
But the institutions are buying, so what are the analysts signaling for the rest of the year?
Yeah.
Are they on board?
The consensus on Wall Street right now is shockingly unified. We're looking at 13 buy ratings, 9 hold ratings, and 0 sell or strong sell ratings.
Wait, really? 0 sells?
0.
In a market this volatile, finding a stock with 0 prominent sell ratings is like finding a unicorn.
It really is. And the 12-month target prices reflect that optimism. The average analyst target is sitting at $385.50.
Okay, so still plenty of upside from here.
Yeah. The most conservative estimate out there is $330, and the most bullish analysts are pointing toward $470.
So here's where it gets really interesting. We have to dive into the great debate here. Is Waters Corporation genuinely undervalued, or is this a classic value trap? Let's start with the value argument. Why is this stock still considered a buy even after jumping 13% in one day?
The argument that it's undervalued is rooted in pure operational efficiency. For instance, the Guru Focus score, which is an aggregate metric tracking profitability, growth, and financial strength.
Right.
It currently rates Waters an exceptional 91 out of 100. But the metric you really need to pay attention to is their return on equity, or ROE.
Where's that at?
It is currently sitting at 29.28%.
Almost 30% ROE. To put that in perspective for you, that means for every single dollar of shareholder equity invested into the company, Waters is generating nearly 30 cents of pure profit.
It's unbelievable.
That isn't just a business. That is a highly calibrated cash printing machine.
It is incredibly efficient capital allocation. And the core of the value argument is that the broader market is only just beginning to understand how successfully Waters is integrating its recent acquisitions.
Right, they've been buying companies up.
They aren't just buying up smaller companies for the sake of growth. They are folding them into their ecosystem and supercharging their margins.
Okay, I hear the efficiency argument, but I have to push back on this.
Sure.
Human psychology in the market is a very dangerous thing. As a retail trader, you see a stock pop 13.5% on your screener. You read the headlines calling it undervalued. You see the 0 sell ratings.
It gets tempting.
Right. Human nature screams, I need to buy this right now before it runs up to $470.
Yeah.
But isn't buying in after a massive single-day vertical gap up the exact definition of a retail trap?
It absolutely is the danger zone for retail investors. I won't deny that.
Because by the time a retail trader logs into their brokerage account and hits buy at $342, the hedge funds and institutions that bought the pre-market gap at $310 are already sitting on massive profits.
Yep, they're already up big.
And the momentum inevitably cools off. The stock consolidates or it pulls back to fill that empty space on the chart. And suddenly, those retail latecomers become the exit liquidity for the early institutional buyers.
It happens every day.
The retail trader is trapped, holding the bag at the absolute top, while the stock slowly drifts lower for the next 3 months.
That is the ultimate paradox of momentum trading. The company itself can be fundamentally flawless, but the specific price at which you decide to enter completely dictates your reality.
The entry is everything.
Exactly. If you let FOMO, the fear of missing out, drive you to buy at the absolute peak of a momentum spike, you are ignoring the basic mechanics of how stocks digest massive gains.
Right. Nothing goes up in a straight line forever.
Never.
Yeah.
Even the strongest companies pull back to retest those moving averages. The trap isn't the company. The trap is the timing.
So to separate the company's true trajectory from the short-term noise of the chart, we need to outline the absolute best case and worst case scenarios for the actual business.
Let's do it.
Let's start with the bull case, the scenario where growth accelerates and the stock actually marches toward that $470 target.
Well, the bull case rests heavily on their recent strategic acquisition of BD's biosciences business.
Okay.
This was not a minor experimental purchase. The integration of that biosciences division added a staggering $520 million in revenue to Waters' balance sheet in the first quarter alone.
Over $500 million in a single quarter. That explains exactly how they were able to confidently raise their Q2 guidance.
It was a massive injection of top-line growth. But the real bull case is looking forward at a major paradigm shift in their product line.
Oh, the new kit.
Yes. Waters recently received FDA clearance for an at-home HPV testing kit.
Okay, let's unpack this for a second. Because moving from clinical lab equipment to an at-home kit changes their entire business model, doesn't it?
It completely alters their total addressable market. Historically, Waters sells highly complex, incredibly expensive diagnostic equipment to hospitals, clinical laboratories, and pharmaceutical companies.
The B2B model.
Exactly. With this at-home HPV kit, they are entering a decentralized, consumer-facing healthcare model. You are entirely bypassing the hospital waiting room and the laboratory bottleneck.
You are turning the consumer's living room into the diagnostic center.
Right. And if Waters can capture a dominant share of the global at-home diagnostic market, the revenue potential isn't just incremental, it is exponential.
Wow.
Couple that with the fact that they are simultaneously seeing a 9% growth in sales to their traditional pharmaceutical customers, and the growth engine looks unstoppable.
So in the absolute best case scenario, the BD Biosciences integration continues to print $500 million a quarter. The at-home HPV kit becomes a staple in medicine cabinets globally, and massive pharmaceutical companies keep upgrading their core lab equipment.
That's the dream scenario.
That is the launch pad, but we have to look at the bear case. What is the worst case scenario that sends this stock tumbling back down through its moving averages? Because honestly, management seems to be executing perfectly.
They are. But if we connect this to the bigger picture, the downside risks for Waters Corporation have almost nothing to do with their internal execution.
Really?
Yeah, the risks are entirely macroeconomic. Waters does not exist in a vacuum. Right now, the most severe drag on their growth is the ongoing economic weakness in China.
Oh, right. China has historically been a massive consumer of international life science and diagnostic tools.
A massive consumer. But when the Chinese domestic economy is sluggish, the first thing that gets slashed are expansion budgets for research facilities and clinical laboratories.
Makes sense.
That macroeconomic weakness in China is directly suppressing the international growth of the very biosciences division that just had such a spectacular first quarter.
And compounding that regional issue, you have a massive global headwind. Currency volatility.
Oh, yes.
Specifically, the persistent strength of the U.S. dollar.
This is a mechanism that often trips up investors who only look at the product and ignore the currency.
Break that down for us.
Well, Waters is an international powerhouse. They sell their equipment all over the globe, which means they are being paid in euros, yen, yuan, and pounds.
Right.
But because they are a U.S.-based company, they have to report their earnings in U.S. dollars.
So when the U.S. dollar is exceptionally strong compared to foreign currencies, the revenue they earn overseas literally shrinks when it gets converted back home.
Exactly. Even if their sales volume in Europe or Asia remains perfectly steady.
Even if they sell the exact same amount.
Yes, even if they are selling the exact same number of machines, a strong dollar mathematically erodes their profit margins. It is a persistent, invisible headwind. Yeah. If the economic situation in China worsens and the Federal Reserve keeps policies in place that keep the U.S. dollar stubbornly high, those two external forces could easily compound.
Could drag everything down.
They could wipe out the margins generated by the new acquisitions and reverse all the post-earnings gains we just saw on the chart.
So what does this all mean when we bring it together? Looking at the short-term outlook versus the long-term reality.
It's a tale of two timelines.
In the near term, it seems highly probable that we see continued structural support for the stock simply because of that institutional reweighting we talked about. The pension funds and the ETFs literally have to buy the stock to match the new EPS guidance of $2.95 to $3.05.
Right. The money has to flow in. That institutional buying pressure creates a very strong floor under the current price in the short term. They aren't buying based on emotion. They are buying based on mathematical allocation mandates.
But the long-term outlook is much more complex.
The long-term outlook is essentially a foot race. It hinges entirely on whether the explosive new revenue potential from the at-home HPV kit and the sustained pharmaceutical demand can physically outrun the macroeconomic gravity dragging them down in China and the currency markets.
Which means Waters Corporation is sitting at a fascinating crossroads. You have brilliant internal execution and massive fundamental synergy clashing directly with volatile, uncontrollable macroeconomic forces.
It is the ultimate battle between a great company and a tough global environment.
And as we wrap up this analysis, we want to explicitly remind you that this deep dive is an exploration of the data, the fundamentals, and the underlying mechanisms of the market.
Yes, it is absolutely not financial advice.
Never. You must do your own research and deeply understand your own risk tolerance before making any investment decisions.
That is especially true when dealing with a stock that has just experienced a massive spike in momentum and volatility. The landscape can change rapidly.
So true. So we leave you with this final thought to ponder. We started by asking if a 13% pop is a golden opportunity or a value trap.
Right.
Consider this. If the BD Biosciences acquisition just added over $500 million in a single quarter, despite those severe economic headwinds in China, what happens to this company's valuation when that at-home HPV kit bypasses hospitals and reaches full global distribution?
That's huge. What if?
Will that decentralized healthcare revolution send the stock past $470? Or will a stubborn, incredibly strong U.S. dollar quietly swallow all of those potential gains before they ever hit the balance sheet? Let us know what you think in the comments. We'll see you next time.